Section 1. Introduction. Overview of U.S. refiners' financial performance. The first quarter of the year has often set the tone for industries, and the U.S. refining sector is no exception. Despite facing moderate profits due to fluctuating crude oil prices and varying demand patterns, major U.S. refiners have demonstrated resilient financial strategies. These strategies are designed not just to withstand the economic pressures, but also to ensure substantial returns to their shareholders. In navigating these turbulent waters, refiners have adopted a mix of traditional and innovative financial tactics. This includes generous dividend distributions and strategic buybacks of shares, which have been particularly impactful. These financial maneuvers are pivotal as they help maintain investor confidence and stabilize stock prices during uncertain economic times. The graph above illustrates the Q1 profit margins for leading U.S. refiners, which, despite being lower than previous years, underscore a managed stability. This stability is crucial for sustaining operations and funding shareholder-friendly policies, which will be explored in the subsequent sections of this essay. The following narrative will delve into how these financial strategies are implemented and their broader implications on the industry and its investors. Section 2. Rewarding shareholders amidst soft profits. U.S. refiners have not allowed softer profit margins to hinder their commitment to rewarding shareholders. This section explores the delicate balance they maintain between sustaining necessary capital for operations and maximizing shareholder returns. It's a strategic equilibrium that ensures long-term sustainability of the business alongside investor satisfaction. The approach involves a careful assessment of operational cash flows and future market predictions. Refiners adjust their shareholder rewards based on these assessments, which often means maintaining or slightly increasing dividends and continuing share buyback programs even in less profitable times. This strategy not only supports share prices but also signals to the market a strong confidence in future profitability. Investment in technology and efficiency improvements plays a supportive role in this strategy. By reducing operational costs and enhancing output efficiency, refiners can manage softer profits while still committing substantial funds for shareholder returns. This dual focus ensures that even when profit margins are thin, the investors' trust and financial interests are robustly safeguarded. Section 3. Dividend distribution strategies. Dividend payouts remain a cornerstone of shareholder reward strategies for U.S. refiners. In the first quarter, despite the economic pressures, many top refiners either maintained or slightly increased their dividend payouts. This move is indicative of their strong liquidity positions and their intent to maintain a stable return to their investors, which in turn reinforces investor loyalty and attracts potential new shareholders. The decision to increase, maintain, or cut dividends is influenced by several factors, including the current profit margins, cash reserves, and anticipated future earnings. Refiners with a strong balance sheet and optimistic earnings outlook are more likely to increase or maintain high dividends. This strategy not only rewards current investors, but also portrays the company as a resilient and profitable investment amidst market volatilities. Furthermore, consistent dividends are often seen as a sign of a company's maturity and reliability in the financial markets. It reassures investors about the company's management capabilities and its strategic foresight in navigating market challenges. Thus, even in a fluctuating market, a steady or increased dividend payout can significantly enhance the perceived value of the refiner in the eyes of existing and potential investors. Section 4. Buybacks, a popular mechanism for rewarding investors. Share buybacks have become an increasingly popular method for U.S. refiners to return value to their shareholders. By purchasing their own shares from the market, refiners reduce the number of outstanding shares, thereby potentially increasing the value of the remaining shares. This not only benefits the shareholders through increased share value, but also reflects the company's confidence in its own financial health. During the first quarter, several leading refiners announced or executed buyback programs. These programs are often strategically timed to take advantage of lower stock prices, maximizing the effect of the buyback on the value of remaining shares. The timing and scale of buybacks are critical, as they must be balanced with the need to retain enough capital to fund ongoing operations and future growth initiatives. Furthermore, buybacks also provide a flexible option for adjusting the company's capital structure and managing its earnings per share. This flexibility is particularly valuable in uncertain economic times, allowing refiners to adapt quickly to changing financial conditions while still promoting shareholder value. This adaptability is a key component in the financial toolkit of modern US refiners. Section 5. Total shareholder returns. Comprehensive analysis. Total shareholder returns, or TSR, is a comprehensive metric that combines share price appreciation and dividend yield to assess the total return generated for shareholders. For US refiners, maintaining a competitive TSR is vital for attracting and retaining investors, especially in a sector as volatile as energy. This section analyzes the components that make up the TSR and how refiners are optimizing these elements. Firstly, the dividends discussed in previous sections contribute directly to the TSR by providing a steady income stream to shareholders. This is complemented by capital gains from increased share prices, often helped by share buybacks. Together, these mechanisms work to enhance the attractiveness of refinery stocks in a competitive market environment. Moreover, strategic corporate actions such as mergers, acquisitions, or divestitures can also impact TSR by altering the company's market positioning and operational efficiency. US refiners often use these strategies to optimize their asset portfolio and improve their market adaptability, which in turn can lead to better financial performance and higher TSR. Lastly, it is important to note that the perception of future stability and profitability plays a crucial role in TSR. Investors value not only current returns, but also future potential. As such, refiners must carefully communicate their strategic visions and operational advancements to the market, ensuring that their potential for future growth is clearly understood and appreciated by the investment community. Market conditions play a pivotal role in shaping the financial strategies of US refiners. Fluctuations in crude oil prices, changes in consumer demand, and regulatory shifts can all significantly impact profitability and, by extension, shareholder reward policies. This section explores how refiners adapt their financial tactics in response to these market dynamics. When oil prices are high, refiners might experience squeezed margins due to higher input costs, unless they can pass these costs on to consumers. In such scenarios, maintaining generous shareholder rewards can be challenging. Conversely, when oil prices are low, input costs decrease, potentially expanding margins and allowing for more aggressive shareholder reward strategies. Regulatory changes, particularly those related to environmental standards and carbon emissions, also demand financial resources. Refiners must invest in technology and processes to comply with these regulations, which can divert funds away from shareholder rewards. However, successful adaptation can lead to operational efficiencies and open up new markets, ultimately benefiting shareholders. Market demand, both domestic and international, further influences financial strategies. A surge in demand can lead to higher throughput and profits, facilitating more generous shareholder rewards. In contrast, a downturn requires a more cautious approach, focusing on cost management and strategic investments to sustain profitability and continue rewarding shareholders. To gain further perspective on the financial strategies of US refiners, insights from industry experts were sought. These experts highlight the nuanced approaches refiners are taking to navigate the complex market environment and maintain robust shareholder returns. This section delves into these expert analyses and their implications for the industry. According to financial analysts specializing in the energy sector, US refiners are increasingly adopting flexible financial policies that can quickly adapt to market changes. This flexibility is crucial for managing risks associated with volatile oil prices and shifting regulatory landscapes. Experts commend this adaptive approach as it allows refiners to maintain financial stability and shareholder confidence even in uncertain times. Experts also point out the strategic use of cash reserves and debt management as key factors in sustaining shareholder returns. By maintaining healthy cash reserves, refiners can buffer against market downturns and fund shareholder rewards without compromising their operational capabilities. Effective debt management ensures that the companies remain attractive to investors by keeping the cost of capital low and financial health strong. Furthermore, industry consultants emphasize the importance of transparent communication with shareholders regarding financial strategies and market challenges. This transparency builds trust and aligns investor expectations with the company's strategic goals. It also facilitates shareholder understanding of the company's responses to market conditions, which is essential for maintaining investor support during less favorable periods. Looking forward, sustainability is set to play an increasingly significant role in the strategies of U.S. refiners. As societal and regulatory pressures mount to reduce environmental impact, refiners are tasked with integrating sustainable practices into their operations. This section explores how these sustainability efforts are expected to influence financial strategies and shareholder values. Innovative technologies that reduce carbon emissions and improve energy efficiency are becoming pivotal. Investments in these technologies not only comply with regulatory demands, but also reduce operational costs in the long run. These savings can then be redirected towards shareholder rewards, aligning environmental responsibility with shareholder value. Additionally, the transition towards renewable energy sources presents both challenges and opportunities for refiners. While this transition requires significant capital investment and operational shifts, it also opens new markets and revenue streams. Forward-thinking refiners who manage this transition effectively can enhance their market positioning and attract environmentally conscious investors, potentially boosting their market value. Experts predict that companies that seamlessly integrate sustainability into their business models will not only benefit from operational efficiencies, but also from increased investor interest. As the market increasingly favors companies with robust environmental strategies, these refiners are likely to see enhanced investor confidence and shareholder returns, setting a new standard in the refining industry. As we look towards the future, the landscape for U.S. refiners remains both challenging and promising. With fluctuating market conditions, regulatory pressures, and evolving consumer demands, refiners must continue to adapt and innovate. The strategies discussed throughout this essay, from maintaining robust dividend policies to leveraging buybacks and embracing sustainability, are all integral to navigating these challenges. The ability of refiners to balance operational needs with shareholder expectations will be crucial. As they invest in new technologies and markets, their financial strategies must remain flexible and responsive to ensure sustained shareholder value. The insights from industry experts underscore the importance of adaptability and strategic foresight in maintaining a competitive edge. Ultimately, the resilience of U.S. refiners will depend on their ability to integrate financial robustness with strategic sustainability efforts. By doing so, they not only ensure their own longevity, but also contribute to a more sustainable and economically stable future. The journey ahead is complex, but with the right strategies in place, U.S. refiners are well positioned to continue delivering big returns to their shareholders.